So you might ask, welcome back. This is the part two, the second part of this course. On the first, we started discussing about what is trading section. We started discussing about trading section, and now we want to discuss understanding the peak period. We have said that the peak period is the period of time when the trading activities is at high peak. So here, what you know about peak period is that the highest volume of trade, you will see the highest volume of trade. If it is a downtrend, you find out that there will be a very high momentum, and if it is an uptrend, the same thing plays out. So there is a highest volume of trade happening here because there is a concentration of traders, right? There is a highest volatility. The market will always show a high volatility, and there is and strength. So how does this play out? You find that it's like when you go to the normal open market. There's a time you will come to the market. If the market opens, you'll find that the people will rush in, and the activities, there will be a peak of the activity. That is the thing. So at this peak of activities, the market will break out, it will pump, and a lot of things will happen. And this is when people start losing their money, because people will see the market pumping and they will start jumping inside the market. And before they know it, the momentum will die off and the volatility will die off. That people have trade and make money and start exiting their position. And then you have jumped in on at the high point. And then before you know it, the market will reverse and you start losing money. So to understand the peak period, it is good to enter the peak period. You don't study the market, except you are trading a strategy we call retracement or pullback. So you might enter a market during this period, right? During the peak period, because the market will pull back. But in peak period, if you are trading pullback in peak period, right? And one thing you will have to pay attention is that the market might not fall at the certain level. So it will drop a little and start pumping. So if you find out that the market is at peak period, there's your strategy and your rules changes if you are trading retracement using Fibonacci retracement. So typically there are two peak periods in cryptocurrency, as it relates to us, that in Africa. Although it's not African market that shaped this period, it's this period is shaped by, like for instance, European market opens around 8 o'clock, 8 a.m. right? The activities of European market start around 8 a.m. and stop at 4 p.m. right? So that's the activity of the European market. So American market, in other words, you know about, if you are coming from the background of forex trading, you'll discover that there is what we call standard Eastern time. Most time American market opens at around 9 a.m. and that 9 a.m. in our own Central African time is 3 p.m. right? So if you look at this, the logic between it, European market is already open and already slowing down. So at around 3 p.m. right, you will discover there is a high period of selling activities, because there is a high number. The European and American market crashes, and you will find that there is a high period of selling activity. So the peak period starts from normally 12:30 a.m. This 12:30 a.m. is influenced by Asian market, because most of Chinese their day breaks around 12 o'clock. So normally they have their peak of the activity of the day around 2:30 to 3 p.m. right? So this period is influenced by Asian market. So you find out that most people who trade, normally, if you want to become an effective trader, you find out that, like I said, that I normally start studying the market around 10 p.m. and 11 p.m. By the time it is getting to 12:30 a.m., I've already identified different trade setup that I will enter, and I will enter the trade. Before you know it, the trade will close and make my profit. I'm not a greedy trader. And the next peak period you will witness is between 12:30 p.m. to 4 o'clock, right, p.m. So, like I said, this is influenced by American market, right? This is influenced by American market. By 12:30 p.m., European market will be at its peak, then slowing down. By the time it is getting to 3 p.m., American market will open, and then they will trade from that 3 p.m. around 5:30 p.m., right? I didn't include that, but around 5:30 p.m., the market will move to what we call after-hour trading, right? So pay attention to this time. If you are trying to structure your trading activities, try to structure it around this trading period. It will give you a lot of room to study the market and make a better trading and increase your trading win rate, right? Because trading according to trading section helps increasing the trading win rate. So the next we are going to talk about is understanding the pre-market period. Typically, there are two pre-market period, right? We have also in peak period. We have the 9 a.m. to 2:30 p.m., right? 9 a.m. to 2:30 p.m. So these are the pre-market period. Around 9 a.m., you start studying the market. When you wake up in the morning, you find out that sometimes the market is not that kind volatile, or the momentum is low, indicating that the Asian market is closing down and it has come to after hour. And then from that after hour, because the European market is getting started, then we start having a pre-market period. So this pre-market period is the time, like I said, is the time that you take time and study to scan the market in order to identify high probability trading setup. So another pre-market period is 9 p.m. to 12:30 a.m. So these are the pre-market period. Here we have a limited volume of trade and liquidity and less momentum. The momentum is not too high, it is not too volatile, and there is a less volatility. So one thing you need to know is that the pre-market period is the best time to study the chart. Then wait for confirmation to happen, and when the confirmation happens at the peak period, it's taken off. Then you trade, you enter the market and cash on the peak period. So in trading, you have to be strategic. That is why I have to bring this course to you, so that when you are structuring your trading activities, you know when to structure your trading activities and when to enter the market and when not to enter the market, right? Because when there is a less volatility in the market, it's not good to enter the market, because whatever signal you will get probably will be a false signal. The same thing with momentum. Whenever there is a lesser momentum, in fact, if you are trading, the major criteria or checklist you have to pay attention is the volume of the trade, the momentum, and the volatility or the trade pressure. If there is the lesser, if this thing are not at its all-time peak, it's better to stay away or keep studying the market and look at the RIS, that is relative strength index, to know when the market is changing. And when you see that, or you can use there's also a momentum indicator they call stochastic indicator. You can use that to check about the if the momentum is building up, so that you can time in your entry perfectly. So the next thing we move into is to discuss the after hour period. Understanding the after hour period. Typically, there are also two after hour period. We have the 4 a.m. to 9 a.m. after hour period. We have the 4 p.m. to 9 p.m. after hour period. At this period, just take it as an assignment. Pay attention. Study this period of time. Just select an asset. Study the behavior of the price action within as this period of time switches. Right? You will discover that there is a change. Right? You understand. Okay, when you start looking at this, you'll find that there is a decrease in volume of the trade and liquidity. There's a decreasing in momentum. There is a decreasing in volatility and the pressure. The price consolidation. Most times you'll find there is a price consolidation, and all these things. Then you start finding that there is a build-up of trade setup. Right? Then after our period, what happens is that institutional investors exit their position, right? So if their institutional investors are exiting their position, that means there is a withdrawal of liquidity from the market. And because there is a withdrawal of liquidity from the market, supply will decrease and demand will decrease, and the price will start consolidating, right? So don't enter the market at this period. It's not advisable to enter the market at the after hour period. So the next thing we got to discuss is crypto trading time belts, right? So crypto market is open 24 hours 7, right? That is 24 hours to all the week is open. But the market is not always at its peak because the market is influenced by the world's financial centers. So this trading, the phases of trading section I called, what gives rise to those trading sections is because of the world's financial centers. We have the London, we have the Frankfurt, we have the New York, we have the Chinese, we have the Hong Kong. All these financial centers affect the price action of the market, right? So, given the versatile different time zones of financial world centers, this gives rise to phases of crypto trading section. So, we have the Asian market, we have the American market, we have the European market, and they all have different time belts. So, when this financial world time belt switch, it affects the liquidity and the volume of trade. So, you need to pay attention to this. And also, trading section, something that I just forgot to mention is that trading section affect the spread bid, of the market, and this also affect how profitability a pair might be within a trading section. So I will stop the second part here. When we come back, we'll continue.